Hi there. So we'll start with reading number 57 of the level 1 curriculum that'll talk about derivative markets and instruments. A very interesting and important concept. So at level 1 we make the basic foundation of derivatives and we do more advanced concepts and the valuations of derivatives at level 2. So it's going to be relatively easy at level 1. However, it is important to understand the dynamics and the concepts here, not just for the exam at level 1, but also because it will be a good foundation for a lot of complex topics at level 2 and level 3. So derivative, as the name suggests, is an instrument or a contract that derives its value from another asset, from another for an interest rate, or from another instrument. So we'll understand derivatives with a simple example. Now that asset can be any instrument or anything in the world. It can be a stock, it can be a bond, it can be a cup of coffee, it can be a table, or as I will use in my example, it can be a book. So let's assume that there is counterparty A who owns a book, and A is going to finish reading the book in another 3 months. So he currently owns the book, and 3 months later he feels that he would have finished it, so he may want to sell the book off. There's another counterparty B who's going to require the book, or who will start reading this book 3 months later. So counterparty A will finish the book in 3 months, whereas counterparty B will start reading this book 3 months later. Now, what is the risk of counterparty A to begin with? 3 months later, he or she may want to sell this book because she's finished reading it and she doesn't want it anymore. So the risk in case A wants to sell the book 3 months later is that the price of this book will go down. Counterparty B wants to purchase the book 3 months later. What is the risk for counterparty B? The risk is that 3 months later, when he or she wants to purchase this book, the price of the book has actually gone up. Let's assume the current price of the book is X. So both A as well as B are okay with the current price of the book. They are willing to pay X. B is willing to buy at X. A is willing to sell this book at X. The risk is that 3 months later the price can go up for B, or the price may go down for A. So can A and B enter into a contract today that 3 months later they will exchange the book for a pre-decided price of X? Let's assume this X is $100. So the contract is happening at t equal to 0. That is, today A and B are entering the contract that A will sell the book for $100 and B will buy the book for $100 3 months later. A sells, so A will set to be short the contract or short the book. B will buy and will be said to be long the contract. The price is pre-decided at both of them will be do it at the price of X, and the time is also pre-decided, that is 3 months later. Now, the value of this contract at any point in time from t equal to 0 to t equal to 3, the value depends on the price of the book. The value is derived from the value of another asset, which in this case is the book. Now please tell me that if 3 months later the price of the book actually goes up, who gains? The contract will have a positive value for which counterpart, A or B? The contract obligates that A has to sell and B has to buy for X. If the price at t equal to 3 is greater than X, then do you agree that A would have gained from the contract? Because, my apologies, A would have lost or B would have gained from the contract, because B can contractually, he has the right and he will buy it for X, whereas the current price of the book is greater than X, so he will buy at $100, whereas the price of the book has gone up to $110, so he gains $10 from this contract because he entered the contract to buy. Similarly, A would have lost because had he not entered the contract, A could have sold it for $110, but because he has entered the contract to sell the book at $100, do you agree that he is in a $10 loss because of the contract? So remember, derivatives are generally a zero-sum game. What this means is that one counterparty's profit is equal to another counterparty's loss. Similarly, if the price was lesser than X, let's assume the price had gone down to $90. Can we all imagine that A would have lost, rather, now A would have gained and B would have lost $10? Because A will sell the book at what price? The contract was entered at t equal to 0. That 3 months later, A will sell and B will buy for $100. So if the price is actually 90, then A would be selling for $100, whereas otherwise he would have only got 90 had he not entered the contract. So in this case, A gains $10 and simultaneously B loses because B could have bought for 90, but now because he has entered the contract, he has to buy for 100. So whether this contract will have a positive value or whether the contract will have a negative value to any counterparty A or B depends on the value of the book or the price of the book. So a derivative is an instrument that derives its value from another asset. So I took the example of a book. In general, for the CFA curriculum and in general in finance, this underlying asset is usually a stock or a bond or an interest rate, etc. So the example that we have given is a forward contract. This is one of the derivatives that we'll study in more detail in the coming slides. And similarly, we'll study other derivatives, most of which would be a zero-sum game. That is, one counterparty's profit will be equal to another counterparty's loss, and their value will be derived from some underlying. So please understand and remember the forward contract. I will refer to this example many times in the reviews. So it's just an agreement between two counterparties to exchange an asset at a pre-decided date at a pre-decided value. In this case, the pre-decided value was $100. The pre-decided date was 3 months from now. It is a right as well as an obligation. That is, A has to sell and B has to buy at $100. So right as well as obligation to perform on the contract. That is to do what you agreed upon. Various types of derivatives exist. We'll study in more detail in the coming slides. So exchange traded derivatives, notably futures and some options, are traded in centralized exchanges or centralized locations and are standardized, regulated, and default risk free. Default risk free implies that the exchange, through a mechanism of margining and through a clearing house that we will study in detail, ensures that both A and B perform on the contract. It is possible that when 3 months pass and the price of the book has actually fallen down to $20 and B says, I'm not going to honor the contract. You can go sue me in the court. I'm just not going to buy at $100. So it is quite likely that the losing party may not honor its obligation. That is a risk of default, that one of the counterparties reneges or fails to honor the obligation that they entered into. To avoid this risk, the exchange traded derivatives employ certain techniques that we'll study when we study futures, and which is why they are default risk free. They're also standardized and regulated, as we'll study. Forwards and swaps. The forward, as we just studied, so this was an example of a forward agreement previously, and swaps that we will study are customized contracts. That is, these are over-the-counter derivatives created by dealers or by financial institutions. There is limited trading of these contracts in the secondary markets, and default risk must be considered. So if counterparty B or counterparty A or one of the counterparties does not honor its obligation, then the other counterparty will have a loss. That is called default risk and loss because of default. So you must ensure that you're dealing with good high credit quality counterparties and you know who you are entering into a contract with in the case of forwards, because there is no exchange to protect your interests. We'll understand these concepts in more detail in the coming slides. A forward commitment, as we studied, is a binding promise to buy or sell an asset or to make a payment in the future. Forward contracts, future contracts, and swaps are all forward commitments. That is, they are a binding promise. So this is what I explained in the example as right as well as an obligation. So both counterparties have an obligation to perform on whatever they promised or whatever they agreed upon. A has to buy at $100, or A has to sell at $100 in our example, and B has to buy. It's a promise to buy at $100. So forwards, futures, swaps, we'll study swaps in more detail in coming slides, are all binding promises or all forward commitments. A contingent claim is an asset that has value only if some future event takes place. That is, if the price of the book is greater than $100, then some payment will be made. If the price is less than $100, then some payment will be made. These kind of derivatives also exist. We will study them in more examples. So options and credit derivatives are generally contingent claims. That is, here there will be a value or there will be a payment due if a particular event happens. Again, we'll study in more detail when we go to the specific topics on options and credit derivatives. Forward contracts, once again, obligate, very important, one party to buy and another to sell a specific asset at a predetermined price at a predetermined time in the future. So I'm not going to explain it again. The example of the book that we did was exactly a forward contract. Swaps are equivalent to a series of forward contracts on interest rates, currencies, or equity returns. So it's just like a forward agreement for 2 years. So every 3 months a payment will be exchanged depending on what the value of the asset is, depending on what the interest rate is, depending on what the currency rate is, or depending on what the equity return has been. Every 3 months a payment will be exchanged between the two counterparties. That's like a swap contract. So the two counterparties swap payments every 6 months or every quarter or every year. Again, study in more detail on the specific topic, but swap contracts are like a series of forward contracts. A forward contract is on one day, that one day in the future an asset will be bought or an asset will be sold at a predetermined price. Futures theoretically are the same as forwards. So all dynamics, concepts remain the same. Only thing is that they are traded on an exchange, hence they are standardized, require daily settlement. We'll study what this means, and hence the default risk does not exist. So the possibility that one counterparty will run away or not perform on its obligations does not exist in futures. We'll study in more detail. Coming to contingent claims, a call option gives the holder of the option the right but not the obligation to sell an asset at a predetermined price at some time in the future. Once again, don't worry about it at this point in time, the slide. We'll understand in more detail when we come to the specific review on options. We just want to give an introduction to derivatives here. You don't really need to know or even understand. Even if you skip the slide, it's fine. So a put option similarly gives the holder the right but not the obligation to sell an asset at a predetermined price sometime in the future. Again, we'll study in detail when we reach the review on options. A credit derivative is a contract that provides a payoff if a credit event occurs. So if one company defaults, or if the bond of a particular company is downgraded, then a payment will be contingent. This kind of a contract will be called a credit derivative. Now, what is the purpose of derivative markets? Why do these contracts exist? Now, many market participants use derivatives to manage and reduce existing exposures. In the example of the book that we did, why did the two counterparties enter into the contract? Were they both managing their risk? Yes. A had the risk that the price of the book may go down. B had the risk that the price of the book may go up. So both the counterparties wanted to manage and reduce their risk. A more practical example could be a corn farmer and a cereal company. So the cereal company manufactures cornflakes, so it needs to buy corn. A farmer produces corn and he needs to sell corn once the corn has been produced. Independently speaking, does the farmer have a risk that he produces the corn and the price of the corn goes down? Similarly, does the cereal company have a risk that they want to buy corn for producing the cereal and the price of the corn goes up by a big amount? Farmer has a risk that the corn price can go down. The cereal company has a risk that the corn price may go up. can the farmer and the cereal company enter into a contract that they will exchange a fixed quantity of corn at a fixed price, a price that the cereal company is also willing to pay and the farmer is willing to accept. So have both of them hedged their risk. So that is one example of why derivatives or why agreements like this can be used, that is to manage and reduce existing exposures. Of course, another counterparty can just be a speculator and enter a contract. So he may choose to sell corn just in the hope that the price of corn will go down. He's not a farmer. He's not a farmer, but he's still selling corn in the future in the hope that price of corn will go down and he will be able to profit. So he will sell at a high price X, and actually when the time of delivery comes, the price of corn will be lower so that he'll be able to buy at a lower price and sell at a higher price. He's not really producing corn, but he just hopes the price of corn will go down, and that is why he's entering the contract. So these kind of participants are not really reducing their risk exposure. They are in the market to profit or to speculate on the prices. And because of a lot of activity like this, sometimes derivative markets are criticized for their risky nature, because if the price of corn actually goes up, then the speculator may have a big loss, etc. But on the whole, we can say that derivative securities are important. They keep the market efficient and they reduce transaction costs, because they definitely serve an important purpose of managing and reducing risk exposures, as we just saw the example of. Derivative contracts are often used to exploit arbitrage opportunities. Now, an arbitrage opportunity refers to the potential of earning more than the risk-free rate of return with no risk, or earning an immediate gain with no future liability. Let me give an example. If there's a city and the city has two spots, spot A and spot B, and the two spots A and B are 1 kilometer apart. The price of potatoes in spot A is $2, and the price of potatoes in spot B is $5 per kg, for instance. Is there an arbitrage opportunity here? Is there a possibility of making riskless profit? Yes, just go and buy the potatoes at point A and sell the potatoes at point B. So if assets, that is potatoes, that is the same asset, is being priced so differently in two markets, then it may give rise to an arbitrage opportunity. That is the possibility of making a riskless profit more than the risk-free rate of return, or earning an immediate gain without any future liability. So you just buy here and quickly go and sell in the other market. Of course, these opportunities don't exist forever, because as more and more people buy from market A, the price here will go up, and if everybody's selling here, the price will go down. So at some point these prices will converge, so that the opportunity doesn't exist for a very long time. This can happen in the stock markets as well. So if the same stock is trading at a price X in one market, and the same stock is trading at a price X plus $5 in another market, then the same logic can be applied and you can buy in one place and sell at the other so as to exploit the arbitrage. So there's an interesting concept called the law of one price, which says that assets that have the same future cash flows or that provide the same benefit must have the same price, or arbitrage can be expected to force the prices of two securities or portfolios to be equal if they have the same future cash flows. So if two assets are exactly the same, for example, our potatoes are the same, then they must have the same price. Of course, if the transportation cost difference, etc., is there, one is closer to the market, etc., then a price difference can exist. But if everything is the same, then they should have the same price. So remember, the law of one price says that assets with similar expected cash flows should have a similar price. If not, there will be an arbitrage opportunity. We'll study at level 2 in more detail how arbitrage opportunities may exist between the stock market and the derivatives market. So if derivatives derive their value from the underlying, so if the derivative is on a stock, then the value of this derivative is derived from the underlying stock. If the value of the stock changes and the value of the derivative doesn't change, then again there may be a arbitrage opportunity. So wherever there is a mispricing, that is similar assets are being priced differently, you can make a riskless profit. And that's the concept of arbitrage. So that's about an introduction to derivatives. Not really deep concepts that we studied here. The next review will be a lot more interesting. We'll understand derivatives, specifically each of the instruments that we discussed today, with more specific examples and numericals on forwards, futures, options, swaps, etc. So thanks a lot, and see you in the next review. So we'll continue with the previous review and take a deeper look now at forward markets and contracts. So we've already studied that a forward contract is a right as well as an obligation to exchange an asset at a pre-decided price at a pre-decided time in the future. Please remember the example of the book. We agreed that at $100, 3 months later, A will sell and B will buy. So a deliverable forward contract on an asset specifies that the long or the buyer will pay a certain amount at a future date to the short who will deliver or sell a certain amount of asset for a pre-decided price. So we'll pay a fixed amount at a future date. Default risk in a forward contract is the risk that the other party will not perform at settlement, because typically no money changes hands at the initiation of the contract. Very interesting and very important. So when A and B entered into the contract that we will exchange the book at t equal to 0, how much money did A give to B or did B give to A? Nothing. So there was no cash exchange at t equal to 0. Whatever exchange will happen will be at t equal to 3. At t equal to 3, A will buy the book and B will sell the book for a price of $100. And which is when one party can renege on its obligation or decide not to honor the obligation, which is the default risk, as we explained in the previous review as well. A forward contract with cash settlement does not require delivery of the underlying asset, but a cash payment at the settlement date from one counterparty to the other, based on the contract price and the market price of the asset as settlement. So a very interesting concept. And remember, most contracts today do tend to be cash settled. So we'll understand. Same example, A and B and the book. T equal to 0, they entered the contract to exchange the book at T equal to 3 for a price of $100. So A sells for $100 and B buys the book for $100 3 months later. At T equal to 3, the market price of the book, let's assume, is $80. Now, typically how we have studied this contract will be extinguished is that B will buy for $100. So B pays 100 and gets the book. A will receive 100 and deliver the book. Now, if B wanted to sell this book, what is the price that he would get? So B bought the book for $100. He bought the book for paying $100. If he now wants to sell the book, what is the price that he'll get? $80, because the price of the book has now become $80. The price can fluctuate. They agreed at $100, but there is no guarantee that 3 months later also the price will remain $100 or whatever they have decided. The price today will depend on the demand and supply of the book today. So if today the price is $80, then B will be able to sell the book for $80, or B will have a loss of $20. Similarly, if A didn't have the book to give, A has an obligation to deliver the book. If A didn't have the book, A would have to buy from the market and give it to B, because there is a contract that they have to enter into that is a right as well as an obligation. So if A has to buy the book today and give it to B, how much price will A give for buying that book? $80, because the current market price is 80. So A will buy for 80 and give it to B for 100, earning a profit of $20. So whether A and B actually exchange the book, or if A and B simply exchange $20. So A receives $20 from B. Is it economically the same thing? Because whether A actually delivers the book and then B sells it, he's made a loss of $20. If A buys the book and delivers it to B, again he's made a profit of $20 because he can buy at $80. So in a contract with cash settlement, we don't deliver the asset, but we just have a cash payment from one counterparty to the other depending on who has gained how much. If the price of the book had become $120, A would have paid $20 to B. Please note, whether you actually deliver or you cash settle, in both cases the counterparties are in the same position as before. So if A receives $20, he can still effectively sell the asset for 100, because in the market he can sell for 80 and then $20 he's gotten from B. So A wanted to sell the asset for $100. If there is a cash settlement, that is A receives $20, then also the same thing has happened. A can sell in the market for 80 and receive $20 from B. So in a cash settlement, you just receive the profit or loss, or just the profit or loss is exchanged between the two counterparties. Economically, delivery as well as cash settlement mean the same thing. Similarly, B would have to buy for $100. B can buy at $80 from the market today, but then he's given $20 to A. So effectively, in a cash settled contract also, B is paying $100 to buy the book. Now very interestingly, let's assume that at t equal to 0, A and B have entered this contract, that 3 months later A will buy the book at $100 and A will sell the book at $100 and B will buy the book for $100. Now let's assume 1 month has passed. They entered into the contract today at t equal to 0, but the exchange will happen at t equal to 3. 1 month has passed and the price of the book has become $130. So who does it look like is gaining in this contract? A or B? If the price is going up, then B is in a gain because he has fixed to buy at $100, whereas A will have to sell at $100. He will not be able to enjoy whatever higher price is there. But this has happened at t equal to 1. The contract actually will expire at t equal to 3. Now A realizes that the price of this book may actually keep going up. He suddenly feels that he made a mistake by entering this contract, because when t equal to 3 comes, the price may actually go up to $200. So he wants to settle the contract today, or he wants an early termination. B may say, no, I don't want to terminate it. I will buy the book 3 months later because I need it 3 months later. A can exit this contract by entering into a new forward contract with the opposite position at the current expected forward price. So today, let's assume contracts are happening between counterparties for a 2-month contract. At, let's assume, $140. So with another counterparty, A agrees to buy at $140 and the counterparty C agrees to sell the book to B at $140. This contract is a new contract, a new forward contract that A has entered into, wherein he has taken the opposite position. In the original contract, A was a seller. In the new contract, A is a buyer, but of course this contract will happen at the current price. So if the price of the book is now around $130 or $140, then nobody will agree to sell the book at $100, right? Today's contract will happen at today's prices. So let's assume today's prices are in the range of $140. So A agrees to buy at $140 and another counterparty C agrees to sell at $140. By entering into this agreement, A has effectively exited or terminated the contract. That is to say that going forward, A has no price risk, or the price of the book can go up further. It will not impact A because A has already agreed to buy it at $140. So now even if the price of the book becomes $200, A will not suffer any more loss. So A was selling the book for 100 and he is buying the book for 140 at t equal to 3. So he will buy at 140 and sell at 100, taking a loss of $40. But the good thing is that this loss is now fixed. Even if the price of the book goes up to $200 or $300, he will not have any further loss because he has already agreed to buy at 140. This is also a right as well as an obligation. Of course, if the price of the book again comes down to $100, A will not have a gain also. That is, his loss will still remain 40 because he has already agreed to buy at 140 and sell at 100. So remember, by entering into an opposite position into a new contract, any derivatives can be extinguished or any derivatives can be terminated early. So we did it with the example of a forward contract. In the future, we'll learn that with a swap, with an option, with the futures, with any derivative, this can be done. That is, if you want to exit the position, just take an opposite position in the same contract with a corresponding maturity. So it was originally a 3 months contract. 1 month later, if you want to exit, then if originally you were short or you were a seller, now you should long. So if you take an opposite position in a corresponding maturity contract, then you would have effectively terminated your position, meaning that now the price fluctuations don't matter. You have fixed your profit or loss. In this case, it's a loss. But and why did you fix this loss? To avoid further loss in the future. Because your view was the price of the book will keep going up. So to avoid that further or future loss, you blocked that loss or you blocked the value. You can similarly lock in your profit also. That is, if B felt that this $130 is enough and the price will actually go down, B can also exit the contract. He just need to sell for 140 and another counterparty C may buy for 140. So if B enters this contract, he is locked in a profit of $40. Because now come what may, he will sell it for 140 and he is buying it from A at $100. So any counterparty can extinguish by entering into an opposite position for a corresponding maturity contract, in this case a 2-month contract. If this new forward is with a different counterparty than the original, for example, in our example it's with C, then there is of course default risk, because if either A doesn't honor his obligation or if C doesn't honor his obligation, then there may be a loss or there may be further complications. So you have to consider the default risk in forwards. In futures, this is not a concern, as we will see. In the example of the farmer and the corn producer, or the cereal company that we gave in the previous reading or in the previous video, both the farmer as well as the cereal company are referred to as end users. So an end user is a forward contract, is a corporation that is hedging the risk. So farmer is hedging the risk of being able to sell his corn in the future. The cereal company is hedging the risk of producing the cereal in the future, hence they are entering into this contract. So they are referred to as end users. People who are entering the contract because they actually want to hedge their exposure. A lot of times the opposite side of the contract may not actually be a end user. So cereal company may be longing, but the short counterparty is not a farmer, it is just a bank. So the bank has short with the cereal company and he has correspondingly longed with another farmer somewhere. So the bank is charging or making a commission or making a profit by longing from the cereal company, or rather by shorting to the cereal company and longing from the farmer. So a bank or a dealer can also take the opposite side of the contract. Generally these banks would have hedged their position because they will have a back-to-back arrangement with the farmer also. So let's say the cereal company buys from 110, whereas the bank sells the corn to the cereal company for 110, and simultaneously they have contracted with the farmer. The farmer will sell for 105 and the bank will buy for 105. So the bank in the process makes a $5 spread or $5 profit because it's hedged his risk. He is buying for 105 and selling for 110. So forward dealers, large banks or brokerages originate forward contracts and take the long side in some contracts and the short side in others, with a spread in the pricing to compensate them for actual costs. That is, there will always be this difference between the long and the short position. So they're long at a lower price and short at a higher price so that they can make some profit or some spread in the middle. So the spread actually compensates them for the cost, the office building, employees, etc. Many costs that the bank has. There is default risk that the bank is bearing on both sides, and any unhedged price risk that they must bear. If they don't get the farmer and they're only with one end, with the short end, then again it's a risk. That's why they'll always short at a higher price and long at a lower price. This is called the bid-ask spread. This 105 is the bank's bid and 110 is the bank's ask. $5 is the spread. Don't worry about the details of the pricing, etc. We'll do it more at level 2. But just remember that in the forwards and derivatives markets in general, there can be an end user like the farmer or cereal company, or there can be an intermediary like a brokerage or a bank who is helping create these contracts. So we'll take the discussion forward with some numerical examples and some specific contracts on financial instruments. So a portfolio manager desires to generate $100 million 100 days from now from a portfolio that is quite similar in composition to the S&P 100 index. She requests a quote on a long position in a 100-day forward contract based on the index with a notional amount of $10 million and gets a quote of 645.5. So let's depict the problem. So we are at t equal to 0 and she wants to generate $100 million 100 days from now from a portfolio that is quite similar to the S&P 100 index. So she wants that at t equal to 100, the performance of this $100 million should be similar to how the S&P index has performed. If the S&P has gone up, then this $100 should also go up. If the S&P index has gone down, then this $100 should also go down, or the performance should be similar to how the equity index has performed. So what she can do and what she has done is the right thing. She goes into a long position on a 100-day forward contract. and the price that is quoted is 645.5. So she buys, or she agrees to buy the portfolio at a price of 645.5. Very similar to our book example. The book was bought at 100, so she agrees to buy at 645.5. Please note, this agreement has happened at t equal to 0. That is, this price is fixed today for an exchange that will happen at t equal to 100. If at t equal to 100, actually the price of the exchange or price of the S&P 500 index or the index based portfolio is 700, would our portfolio manager have gained or lost? She has agreed to buy at 645.5. She will sell at 700, so she would have gained. If at t equal to 100, actually the value of the index is 600, would she have gained or lost? Please note, this contract is an obligation. So she will buy at 645.5 and now she will be able to sell at 600. That is, now she would have lost. So at t equal to 100, or rather at t equal to 0, the manager longs the S&P 500. If the index level at the settlement date is 668.1, so at t equal to 0 or at t equal to 100 rather, the market price is 668.1. That means she has gained, or she'll buy 10 million worth at 645.5 because the amount is 10 million, and she'll sell 10 million worth at 668.1. So what will her gain be? Sell at 668.1, buy at 645.5 divided by 668.1 multiplied by 10 million, because this whole transaction was for an amount of $10 million. Similarly, if the price had gone down to 600, please verify, she would have had a loss because she would have sold at 600, again bought at 645.5 and incurred this loss. So sell at 600, buy at 645.5, an amount worth of $10 million. So by longing this forward contract, she has essentially converted her $10 million position into a position on the S&P 500, because if the S&P 500 goes up, she gains. If the S&P 500 goes down, she loses. So her portfolio now will generate a return similar in composition to the S&P 100 index. So she desires to generate 100 million in 100 days. So she desires 100 million in 100 days, and that means she's expecting the index to go up 10 times. So you can just say that $10 million is what she desires. That's why she's longed an amount of $10 million. So 3.5%. If it's $100 million, then it will be 3.5 into 100. But in our case, the notional was 10 million. There's some mistake in the question, I guess. But never mind, the concept remains the same. Basically, 3.5% is the gain that she has. depending on whatever is the notional amount, 10 or 100, will be her payout. Alternatively, if the index was 2% below, then there would have been a loss of $2 million on a $100 million notion. So similar concept, similar contract can be written on a book, as we first studied, can be written on a stock index, can be on an individual stock. Needn't be the S&P 100. We could have just had the same agreement on one particular stock A as well. It can also be on treasury bills. Remember, treasury bills are zero coupon bonds. So they do not pay any coupon like a regular bond. So they trade at a discount. That is, if they are going to redeem or at maturity, they will pay you $100. Then today, you will pay a lesser price to buy them. The difference indicating your interest that you have earned because you pay a discount to purchase them. A forward contract covering $10 million face value of T-bills that will have 90 days to maturity at contract settlement is priced at 2.35 on a discount yield basis. Compute the dollar amount the long must pay at settlement for the T-bills. This question is more on understanding the discount yield convention rather than the payoff on the forward contract. So it has 90 days to maturity and is priced at 2.35 on a discount yield basis. That is, the annualized discount that the bond or the T-bill is trading at is 2.35%. So the bond, which will redeem a par value at maturity, let's assume $100, is trading today at a discount or an annualized discount of 2.35%. If 2.35% is the annualized discount, then what will be the discount for 90 days? It will be 2.35% into 90 by 360. Or the absolute discount would be 2.35% into 90 by 360 into $10 million. That is, if the T-bill is going to redeem $10 million, then we are actually willing to settle, or we are actually willing to buy, or the short is willing to sell this bond for a price of 10 million minus the discount. So once again we'll understand, at t equal to 0 we are entering into the contract to mature at t equal to t. At what time does it mature? It is not given. However, at maturity, whenever this may be, this bill will have another 90 days remaining to maturity. That is, in another 90 days from the settlement of our contract, this treasury bill will give us $10 million. So whoever is longing the contract at t equal to t, will he pay $10 million or slightly less? He'll pay slightly less because at maturity, which is 90 days from now, he will get $10 million. So today this bond is, or at t equal to 2, that is the expiration, the bond is being priced on a discount basis of 2.35%. That is an annualized discount of 2.35%, or the price 90 days earlier will be decided as 10 minus 2.35% into 90 by 360 into 10 million. So this is the price that they have agreed to. So the long counterparty will pay P and receive the bill. The short counterparty will receive the price P and deliver the treasury bill. Now when this maturity actually happens and the time to maturity is not given, if interest rates go up, then the discount basis may go up. That is, the actual price of the bill may come down and the short may gain. At t equal to, that is at expiration, if actually interest rates go down, that means they have agreed on a 2.35% discount, but actually discount may come down, that is interest may come down, or the price may go up and the long position may gain. So the payoff on a T-bill forward will be very similar to the stock forward. It will again depend on the price. The price may be quoted on a discount yield basis, or they could have in the question just given you that the contract settlement is priced at 98.5. Instead of giving you a discount yield basis, they could have just given you the agreed upon price. So that actually, if the price of the treasury bond is 98.9, the long gains. If the price is 98.2, the short will gain, which is exactly the same as the book example or the equity index forward that we studied in the previous example. Only thing in this question is that the pricing is not being quoted as an exact price, it is quoted on a discount yield basis. So 2.3% discount yield basis means actually a price of 10 million minus 2.35% into 90 by 360. We'll just show this calculation. So 0.0235 into 90 into 12. So that means they have agreed on a price of $9.9 million. If the actual price is greater than 9.9 million, the long gains. If it is less than 9.9, the short gains. It will be greater if interest rates have gone down. The price will be lesser than 9.941 if interest rates have gone up. Interest rates going up causes bond prices to decline. So remember, an equity forward contract may be on a single stock, a customized portfolio, or an equity index. In our example, we gave the example of an equity index. Could have very well been on a stock or a customized portfolio also, and is used to hedge the risk of equity prices at some future date. Equity contracts can be written on a total return basis. That is, the long will receive not just the price return, that is the price movement, but he will also receive the dividends if the stock or the index gives any. But typically they are based only on the value and dividends are excluded. Index forwards settle in cash based on the notional amount and the percentage difference, as we explain in our example, between the agreed upon value and the actual level of the index. So in our example, the agreed upon value was around 665, the actual value was higher, and hence there was a payment. Forward contracts in which bonds are the underlying may be quoted in terms of discount or in terms of the yield to maturity. In our example, we use the discount basis yield. Very well, the yield to maturity could have also been given and we could have derived the price from there. Forwards on corporate bonds must contain special provisions to deal with the possibility of default, or if there is any call or conversion feature, then also that must be accounted for in the agreement if the call gets triggered, etc. Forward contracts may also be written on portfolios of fixed income securities or on bond indices, just like they are written on equity indices. So basically, the underlying can be any asset. It doesn't necessarily have to be one stock or one equity index. There are two counterparties that are agreeing at the price of a particular asset. That asset can be a bond, can be a stock index, can be a book. If the price actually at maturity is higher, the long gains. If the price actually is lower, the short gains. That asset can be anything, can be a bond index, can be an equity index, can be a book, can be a cup of coffee. Now, another interesting convention that all of you need to understand is the concept of euro-dollar deposits. Euro-dollar refers to dollar deposits outside the US. Similarly, euro-yen would refer to as yen deposits outside of Japan. Euro can also be there. Euro deposits would mean euro deposits outside of Europe. So remember, a euro-dollar rate is actually a dollar denominated rate only. So these are USD denominated short-term unsecured loans to large banks outside the United States. They could be in Europe, could be in Japan. They have to be, euro implies it's outside of your home country. So euro-dollar means dollar deposits outside the US. Euro-yen means yen deposits outside Japan, so on and so forth. So moving back to euro-dollar, that is what we want to understand in more detail. There are USD deposits outside Japan, so banks like Barclays, Deutsche Bank, these are all banks that are based outside US, but they accept dollar deposits. So when Deutsche Bank receives a dollar deposit for, let's say, 30 days or 60 days or 1 year, then what is the rate of interest that Deutsche Bank is offering for accepting that dollar for a 30-day period? So let's say Deutsche Bank says that 2% I will give you if you put your money in my bank for 30 days. So that will be the 30-day LIBOR. I'll give you 2.1% annualized. Okay, rates will always be annualized if you put the money for 60 days in my bank. Similarly, if you put it for 1 year, I may give you 2.2% on an annualized basis. So the London interbank offered rate is the rate that these banks outside the US are offering on euro-dollar deposits. That is, on dollar denominated deposits. So in practice, it will not just be Deutsche Bank. All banks will be giving their rates. That if you put money for 30 days, we'll give you so much. If you put for 60 days, if you put for 1 year, this is the annualized rate that we will give you. So there are normally 13 or 14 large banks whose rates are collected, and then an average is taken, and that average of what is offered for 30 days by all banks will be that day's LIBOR, or the London interbank offered rate. So the LIBOR rate changes every day, because every day the banks may offer a different rate for a 30-day deposit or a 60-day deposit or a 180-day deposit. So every day the LIBOR is posted at the end of the day, and that will be that day's LIBOR or that day's interbank offered rate for various maturities, normally short term, up till 1 year. Similarly, Eurobor will be a euro denominated rate. So this will be the rate for euro denominated assets, or for euro deposits, what is the bank offering. For both LIBOR and Euribor, rates are expressed as annual rates, and the actual interest is based on the loan term as a proportion of a 360-day year. So if it's a 5% LIBOR or a 3% Euribor, what this means is that first of all the rate is annualized. So for a 30-day, the actual interest will be 30 by 360 into 5% into the notional. For a 90-day LIBOR, if the 90-day LIBOR is 5%, that means on $100, after 90 days you will get 100 into 90 by 360 into 5%. So we'll do it with an example and understand the concept. Compute the amount that must be repaid on a $10 million loan for 90 days if the 90-day LIBOR is quoted at 14%. So the rate will always be annualized. That means the interest part will be 14% into 90 by 360 into 10 million. And of course, you have to return your principal that was equal to $10 million. So at the end of 90 days, the total money that you will pay will be 10 million into 1 plus 0.14 into 90 by 360. So remember, LIBOR and Euribor, or LIBOR is a US denominated rate and it's an add-on rate. That is, this rate is not a discount like in the case of T-bills. It's actually the number that will have to be paid over and above what you borrowed. So total $10.35 million is what you'll have to give at the end of 90 days. Just like we studied forwards on T-bills or on equities, forwards can be on currencies as well. So RVSP expects to receive US dollars 10 million 6 months from now. So we are at t equal to 0 and at t equal to 0.5, or you can say 6 months, this company expects to receive $10 million. And enters into a cash settlement currency forward to exchange these US dollars for INR at INR 61.6. Now understand what is happening. This RVSP probably is an Indian company. The Indian company has made a sale in the US and he's been guaranteed that 6 months later we will pay you $10 million. But in which currency do you think RVSP will be having its expenses? If it's an Indian company, then its expenses and costs and payments to suppliers most likely will be mainly in INR or in Indian rupee. So what is the risk that RVSP is facing? That the INR depreciates or the INR reduces in value. Today, he can enter into a forward contract at 61.6. That is, for $10 million, he can be guaranteed 10 into 61.6 INR. If he doesn't enter this forward contract, then what is the risk? INR may go down to 60. If the INR 6 months later goes down to 60, then he will not get $61.6 million. He will only get 60 million INR. INR, not dollars, my apologies. So he wants to hedge. He says that I'm willing to accept 61.6 INR to the dollar, that is $61.6 million. If 6 months later, actually the exchange rate has become 62.6, then do you think RVSP has gained or lost by entering this contract? Otherwise, had he not entered, he would have received 62.6 into 10 million. Now how much will our RVSP receive? Only 61.6. So on $10 million, RVSP could have received 62.6, but he will actually receive this much. And if he sells so he is buying the INR for 61.6. So the agreement is that RVSP at T equal to 6 months will deliver $10 million and receive 61.6 into 10, that is 616, not 61.6, 616 million INR. He enters into a cash settled currency forward to exchange these US dollars for INR 61.6 per dollar. That is, the contract is that at T equal to 6, RVSP will deliver $10 million and receive so much INR. Now what has happened is that at T equal to 6, actually the dollar is worth 62.6 INR. So he will sell the dollars for 61.6. But if he had to buy the dollars, he would have had to pay how much? 62.6, because the current market price is 62.6. Or you can also think of it as we explained. That is, he is getting only 61.6. Whereas if he did not enter the contract, he could have earned 62.6 or per dollar, or $626 million. So what will be his total loss? It will be minus 1 into 10 million, that is 10 million INR. That is, he is getting 10 million INR less. If it had actually become 60, he would have gained 1.6. because he would have sold the dollars for 61.6, whereas today the rate is only 60, or he would have gained 16 million INR. So in this case, he would receive 616 million. Without the contract, he would have received 626 million, or you can say there is a loss of 10 million INR. That is the difference between the two. So currency forward contracts specify that one party will deliver a certain amount of currency in exchange for a certain other amount of currency. Like in our example, we were delivering $10 million and receiving 616 million INR. Under cash settlement, a single cash payment is made at settlement based on the difference between the exchange rate fixed and the market exchange rate at the settlement date. So in our previous example, we or RVSP would have paid $10 million to the counterparty. Otherwise, if dollar had gone down to 60 INR, then RVSP would have received $16 million from the counterparty. In our case, we would have to pay another $10 million. The last concept that we'll study in this review is that of forward rate agreements. So just like we agreed on the price of stocks, the price of the book, the value of the currency at a future date, can two counterparties A and B agree on an interest rate in the future? So there is a counterparty A that wants to borrow 6 months later, and the counterparty B is going to receive money and he wants to lend his money 6 months later. So A needs to borrow, B needs to lend 6 months later. What is the risk of individual or counterparty A? The risk is that interest rates may go up. If they go up, then A will have to pay more interest. What is the risk for counterparty B? That 6 months later, interest rates may go down. Because if interest rates go down, then when B lends his money, he will get a lower interest. Both of them are okay with the current interest rates. So can A and B enter into an agreement that 6 months later A will borrow at X% and B will lend the money at X%. By entering this agreement, have both of them hedged their risk? If what B is scared of becomes true, that is if interest rates go down, it doesn't matter because B has already agreed to lend at X%. If interest rates go up, then A gains because A has already agreed to borrow at X%. So in the future, who wins or loses depends on whose view goes right. If interest rates go up, A gains. If interest rates go down, B gains. Just like in our stock market example or in the currency example, the movement of currency in the future decides which counterparty gains, which counterparty loses. So forward rate agreements serve to hedge the uncertainty about short-term rates that will prevail in the future. If rates rise, the long receives a payment at settlement. The short receives a payment if the rates fall below a contract rate. So we'll understand this better with the help of an example. Please note, the borrowing or lending has to be for a predefined period. So borrow at X% for, let's say, 3 months. Lend at X% for 3 months, or for 1 year, or for 2 years. So the rate has to be decided at the beginning of the contract. When will the borrowing or lending happen? That is 6 months later or 3 months later has to be decided. And for what period will be that borrowing or lending, 3 months or 6 months after the borrowing, also has to be decided. The payoff will depend on whether interest rates have moved up or down as against the contracted rate. So let's do an example and understand better. Consider the buyer of a 6 into 9 FRA. Never mind this notation. What this simply means is that two counterparties are entering into a contract to borrow money 6 months later for a period of another 3 months. So 6 months later, one counterparty will borrow and another counterparty will lend. And that borrowing and lending will happen at what rate? The contract rate is 6.35%. Please note, rates will always be annualized. So the rate is 6.35% for a period of 3 months. 6 into 9 means 3 months is what the borrowing or lending will happen for. And of course the notional amount is 10 million. So A will borrow $10 million at 6.35% and B will lend $10 million at 6.35%. The borrower is generally called the buyer in the agreement, and the lender is generally called the seller in the forward rate agreement. If the settlement rate is 6.85%, that is at t equal to 6, the interest rate actually for 3-month borrowing or lending is 6.85%. Who do you think has gained? The borrower or the lender? They have both agreed on a rate of 6.35%. Actually the rate is 6.85. The borrower gains, because otherwise he would have had to pay 6.85. Now he will only pay 6.35% because that is the contract that they have entered. The lender loses. The lender could have earned 6.85%, but now he will only earn 6.35% because that is again the contract or the agreement that they have entered into. So the payoff is calculated as the interest gained or lost. For A, how much has he gained? He would have had to otherwise pay 6.85 because that is the rate what it is. He will now only pay 6.35%. Please note these rates are annualized. So for a 3-month borrowing, the interest saving would be 90 by 360. 3 months is 90 days on a year of 360. And the amount borrowed is how much? $10 million. That is also given in the question. So do you agree that this is the amount of interest A has saved? Or in other words, you can say B has lost so much interest. Do we agree? Because otherwise he could have lent at 6.85. So the negative of the above is what B has lost. Now just one convention that you have to understand is that this interest gained or lost will actually be enjoyed when? At t equal to 6 or t equal to 9? When do you have to pay the interest? At the end of the borrowing period or at the beginning of the borrowing period? You pay the interest at the end. So if you're borrowing at t equal to 6 for a period of 3 months, then this interest actually, or this saving actually would happen at t equal to 9, that is at the end of the 3-month period. But an FRA or a forward rate agreement is settled at t equal to 6 itself, that is, it is settled at expiration. So this is the interest saving, or this is the amount that the seller in this case, or the lender, will have to pay the borrower. So it will be negative for the lender and positive for the borrower. However, it should be paid at t equal to 9, but it is settled at t equal to 6. That's just a convention of FRAs. That is, they are settled at expiration. Hence, the amount exchange is equal to the present value of this difference. So the amount exchange will be the present value. The present value means you will discount it back at the current rate, that is 6.85%. So 1 plus 0.0685 into 90 by 360 is what we would do to compute the payment at t equal to 6. So payoff is the interest gained or lost, but it is settled at expiration. Hence, we compute the present value, and that is the amount the winner will pay the loser. In this case, the lender will pay the borrower. If interest rate had gone down to 6%, then by a similar calculation, the borrower would have paid the lender. So just to give you a formula, you don't need to remember the formula, but you can say that the payment to the long at settlement will be given as the notional principal amount, that is the $10 million, into the reference rate at settlement minus the FRA rate. So the reference rate at settlement was 6.85, the FRA rate was 6.35, if I'm not mistaken. That was 6.35 into the days in the loan terms upon 360, that is 90 by 360. But you will discount it back 90 days, or discount it back days in the loan terms, that is 1 plus the reference rate at settlement, that is 6.85 into 90 by 360. So to explain, the numerator is the difference between the rate on a loan for the specified period at the forward contract rate and the rate at settlement. The denominator is to discount this interest differential back to the settlement date at the market rate at settlement, that is 6.85%, because the payments ideally should be exchanged at the end of the loan, because interest is paid at the end of the loan. But because we are settling it at the beginning of the loan, we need to discount it back, and that is the payment that the loser will give to the winner. So that was about the review on forward contracts, an important concept, a slightly difficult concept. If you've understood this concept, then the future concepts will just build on these concepts and similar explanations. So make sure you watch the video once again, do a few more questions on your own so that you understand the concepts for yourself and understand what the meaning behind this concept is. So we'll study about futures contracts in the coming review. Thanks a lot, and reading 59 of the curriculum will take us through the concepts of futures, markets and contracts. We earlier studied about forward markets and contracts. Please note that conceptually and from a standpoint of calculating payoffs and profits that we did in equity forwards, currency forwards, T-bills, forward rate agreements, concepts in futures and forwards are exactly the same. So payoff is calculated exactly the same way. The forward contracts, however, can have certain peripheral problems which futures markets do away with. So let's assume that A and B agreed to exchange corn, or the example that we did, they wanted to exchange a book, or they agreed upon the price of rice, for instance, or any other commodity. Is it possible that at maturity, that when the time to exchange comes, A may say that this is not the quality of corn I wanted. I agreed on a better quality corn. Or A and B may have a dispute on the quality of rice. Or A may say, no, the book is not in good condition. I wanted the book in good, perfect condition. That's what we agreed on. And B will say, yes, it is in perfect condition. But they may disagree on the quality of the product. The other problem that we studied in a forward contract is very simple default. B just runs away. B says, I don't care about your agreement. I'm not going to honor it. Are these both practical problems in the forward contract that you may have to deal with? And these are what are done away in futures markets. So the first and important concept of the futures market is, as we will study in more detail, is that it is standardized. So the exchange ensures that the corn is of the quality agreed upon. So basically there is somebody who agrees, or somebody who ensures that all parameters are met, so that both the buyer as well as the seller are assured that there will be no problem of quality. And second, there is a concept of margining and mark to market that we will just study, which ensures that there is no default. That is, sufficient deposit is taken from all counterparties that even if they run away, there is sufficient deposit money with the exchange that it can pay the other counterparty. So there is no default risk also in a futures contract, and we'll understand how this is executed. So like forward contracts, future contracts are most commonly for delivery of commodities and financial assets at a future date and can require physical delivery or settlement in cash. Compared to forward contracts, however, so payoff is exactly the same. Everything else is exactly the same. But compared to forwards, futures contracts are more liquid, trade on exchanges, and can be closed out by an offsetting trade. What is this offsetting trade? If you were long 3 months forward and 1 month later you want to finish the contract, you want to lock in your gain or you want to lock in your loss, you can simply go and short a 2 month forward. Of course, when you do it in a forward, there is default risk because you may be shorting with somebody else, you have longed with somebody else, and there may be a default risk if one of the counterparties defaults. But if you long a 3 month future, you can very easily close out this position by shorting a 2 month future, because both the long and the short position are against an exchange or with an exchange. So these offsetting trades or trades on a future do not have counterparty risk. There is an agency called the clearing house that acts as a counterparty to each side of the contract. So when you are long, you don't know who the other side is. For you, the long is the clearing house. CH is what I'm calling it. Similarly, when the short counterparty is shorting, he doesn't know who is the other side. A and B don't know each other, unlike a forward contract. For A, he is going to buy from the clearinghouse or from the exchange, and similarly B is selling to the clearinghouse or to the exchange. The clearinghouse will require a margin. That is, if you have agreed, if A and B have agreed to long a book for $100, who will gain eventually? At maturity, that is 3 months later, who will gain? Will the long gain or will the short gain? Can we know today? We can't, right? That will depend on what is the price of the book 3 months later. If the price is 120, A gains. If the price is 80, the short position will gain. But that we can't know today. If A gains, he has to be paid 20. If B gains, 20 has to be taken from A and paid to B. But today, when they have just entered the contract, nobody is in a gain or loss. As time passes, one party may come in the money, another may go out of the money. That is, if the price keeps going up, then A is coming in the money or gaining. Price starts to go down, then B is coming in the money or B is gaining. However, to begin with, in a futures contract, both A and B have to pay a margin. So A also has to pay $20 to the clearinghouse or to the exchange. B also has to pay $20 to the clearinghouse to the exchange. Even though none of them are in any profit or loss, they still have to pay $20. What does this ensure? This ensures that in the future, even if B is in a loss of $10 and A has a gain, remember it's a zero-sum game. So one person's loss is going to be another counterparty's profit. So let's assume A loses $10 and B gains $10 and B decides to run away. Will that have any problem for us? No, because we already have $20 of deposit. So the exchange will set this deposit amount taking into account the volatility of the asset, so as to ensure that even if B runs away, there is enough money so as to compensate the other counterpart. Of course, as B keeps going into more and more loss, the exchange will ask him to put up more margin, so that at any point in time there is sufficient extra money taken from both counterparties, so that even if there is a big loss the next day, that loss, or even if the counterparty reneges, there is enough deposit so as to make up for that loss. So every day there is a mark to market done. So first of all, you pay $20, that is the initial margin, and then they are marked to market daily. That is, every day, depending on how the price is moved, each person's profit or loss is calculated, and depending on which, more margin may be asked. So if B is going in a loss, exchange will always keep asking for more margin, so that even if B runs away, they have enough deposit to make good the other counterparty's profits. Futures have generally lower transaction costs as compared to forwards. They are standardized contracts, as we discussed. So the quality of rice, the quality of the book, the number of shares, etc. is already decided by the exchange. So they are standardized as terms of the quantity, quality, settlement date and delivery requirements. As to what time of the day does the delivery have to be made, all that also is fixed by the exchange, so that the performance of the contract can be assured. So remember, payoff mathematically, futures are the same as forwards. It's just that because of these arrangements, dealing becomes a lot more safer, and hence there is higher liquidity and higher trading that can be done. We'll understand margining in a little more detail and with a numerical example. So Futures margin deposits are not loans. So that initial $20 that both A and B had given is not a loan, it is a deposit to ensure performance. That is, if one of them has a loss and runs away, still there is enough cushion or enough deposit to make good the other counterparty's profit. Initial margin is the deposit required to initiate a futures position. So in this case it was $20. Maintenance margin is the minimum margin amount. When the margin falls below this amount, it must be brought back up to this initial level by depositing a variation margin. So understand? This is the clearing house, this is counterparty A, this is counterparty B. Initially both of them deposited $20. So both of their deposit balance with the clearing house is $20. Now next day, A is the long counterparty, B is the short. Next day, the asset price goes up by about $10. So who has gained? A or B? Long means he'll buy. He'll buy at a fixed price of X and B will sell at a fixed price of X. If the asset price goes up, the long has gained by $10. So the long's account or margin balance has actually become $30. Or rather, it has become 20 plus 10, 30. B has lost $10. So B's margin is now not 20 because he's also lost $10. So his outstanding balance with the exchange is only $10. So in futures what can be done is that A will be allowed to withdraw $10 from the margin account. The exchange will also inform something called as maintenance margin. So let's say maintenance margin is $15. That is, if your margin account balance falls to $17 or $18 or $16 even, exchange will not bother you. You don't have to worry about it. But if your margin account goes below $15, below the maintenance margin, then your margin must be brought back up to the initial level. That is, you have to take it back up to $20 by putting a variation margin, which in this case would be another $10. So because his margin balance fell to $10, which is below $15, so he'll have to put another $10 or give $10 to the exchange to bring his margin back up to 20. The reason this is being done is to ensure that if the stock falls another $20, then the margin account should never become negative. Because if the margin account becomes negative, then B can run away and there will be a possibility of default. So margin account should always be positive. Hence you ask for more money. So that even if the stock goes up further or there is a further loss in the position, then the deposit can be made, or there is enough deposit to ensure the other counterparty can be paid. Margin calculations are based on the daily settlement price. That is the average of the price for trades during a closing period set by the exchange. So the settlement price generally is the last 15 minutes price, or the average price of the last 30 minutes or the last 15 minutes. The reason the exchange does a 15-minute or a 30-minute and not the last traded price is to avoid manipulation. So we can manipulate the futures market by making sure that the asset closes at a very high price. So just the last traded price is not what is taken. It is the price of the last 15 minutes or the last 30 minutes as set by the exchange. Based on that, everyday profit and loss is calculated, and some margin can be withdrawn or more margin may need to be put up. You understand this with an example? Consider a long position of 10 August rice contracts. each of which covers 1000 bushels. Assume that the contract price is INR 30 and that each contract requires an initial margin deposit of 500. So if there are 10 contracts, then the initial margin would be 10 into 500 and a maintenance margin of 200. So until 200 the exchange won't bother you, but if your margin account goes below 200, then you'll have to bring it back up to 500. So the total initial margin for the 10 contract trade is 5000, as we also calculated. Maintenance margin will be 2000. Compute the margin balance for this position after a 30 paise decrease in price on day 1 and a 10 paise increase in price of day 2 and a 20 paise decrease on day 3. Just for the knowledge, 100 paise is equal to 1 INR. So 30 paise would mean 0.3 INR. So please note it's a long position. So you are long. Let's see what your margin account balance is. To begin with, you have an initial balance or initial margin of 5000. At the end of day 1, the price has decreased by 0.3 INR. So if the price per bushel has increased or has decreased by 0.3 INR, okay, so 0.3 paise per bushel, then what will be your loss? If price goes down, a long position loses. If price goes up, a long position gains, as we've been studying. So 0.3 into 1000 into 10, that is, for 1000 bushels in one contract, there is a $0.3 loss, or 0.3 INR loss rather, and for 10 contracts this would be into 10, so it will be 300 into 10, that is 3000. So at the end of day 1, the margin balance has gone down to 2000. Because there is a loss of 3000. So you had 5000, but the loss of 3000 would take the balance down at the end of day 1 to 2000. So at 2000 you will get an margin call, that is, you will have to pay additional $3000 at the end of day 1 to bring the price back up to 5000. Actually, till to 2000 the exchange won't bother you. So it's a very fine situation here. But generally, if it is below 2000 or even at 2000, we will assume, then the exchange will say no, this is too low an amount, so you will be required to deposit a variation margin at the end of day 1 of 3000, such that the value of your margin at the end of day 1 becomes again equal to $5,000, because you've had a loss. So this is just to avoid the risk that if there is further loss the next day, you may renege on your obligation and you may default. At day 2, there's a 10 paise increase. So there's a $0.1 increase per bushel. So 0.1 into 1000 into 10, that is, there will be a total gain of $1,000. So if there's a gain of $1,000, then your margin position will become, or your balance will become 6,000. In such a case, you may even be allowed to withdraw $1,000 just like you had to deposit additional $3,000. Now let's assume you don't withdraw. So at the end of day 3, there is again a 20 paise decrease in price. So there will be a loss of 0.2 into 1000 into 10, or your margin balance will again come down by 2000, and at the end of day 3 it will become 4000. At the end of day 2 it was 6000. At day 0 it was 5000. At day 1 also it will again become 5000, but you will have to put another 3000 of variation margin. So the exchange ensures that there is always enough money with the exchange so that even if you have a loss, this margin balance shouldn't normally go negative. It will always be a positive number. So that even if you go away or run away, the exchange has enough balance so as to meet the demands of the other counterpart. So the price changes were per bushel. So to begin with, the balance would be 5,000. Then it would go down to 2,000. You would put up additional $3,000. So the balance would again come to 5,000, and because you have a gain of 1,000, the balance will become 6,000. At day 3, there will be a loss of 2,000, so that the balance comes down to $4,000. The process of calculating this gain and loss on a daily basis is called marking to market. So marking to market is a process of adding gains to the margin account or subtracting losses from the margin account daily based on the change in the settlement prices from one day to the next. The mark to market adjustment either adds the day's gains in the contract to the long's margin balance and subtracts it from the short's margin balance. It's a zero-sum game. So if to one counterparty's margin balance we are adding, to the other counterparty we will subtract. Or it subtracts the day's loss in contract value from the longs and adds it to the short. So if the price goes up, you will add to the margin balance of the long and subtract from the short. If the price goes down, you will subtract from the margin balance of the long and add to the margin balance of the short. A lot of times exchanges put a limit down and a limit up rule. That is, trades cannot take place at prices different from the previous day's settlement price by more than a price limit, and are said to be limit down or limit up when the new price is below or above the maximum price for the day. Because please note, we have only taken $5,000 margin. If the price movement is of 1 INR per bushel, do you agree that the margin balance for the one counterparty can even become negative? Because you took only $5,000 of initial margin. If the movement is more than 0.5, if it goes up more than 0.5, the shorts balance will become negative. If it falls by more than 0.5, the longs balance can become negative, and then you may have the risk of default. So exchanges put a limit on the trades. That is, trades cannot take place at prices different from the previous day's settlement prices by more than a limit, so that the margin balance doesn't go negative for any counterparty. So you say that the account or the stock is limit up or limit down because the stock cannot trade because the price movement either up or down has exceeded the limit. You often hear that in the market, that the price is limit up or the stock is limit down, meaning that stock has already moved up so much that now the exchange has stopped trading. It is first going to settle these trades and recover the variation margin from the counterparties and then allow trading, so that there is enough margin balance in each counterparty's account. Just like we terminated a forwards contract, a futures position can be terminated by an offsetting trade, that is entering into an opposite position at the same contract. So this is the best way, or this is a good way to exit the contract before maturity, that is an early termination. So if you're long a 3-month contract and you want to extinguish this contract 1.5 months later, just short a 1.5 month contract. So take an opposite position in a corresponding maturity contract. At expiration, you can have delivery or you can have a cash settlement. That is, just exchange the profit or loss. In delivery, you actually take delivery, the short delivers and the long pays the short. Economically the same as we explained in the review on forwards as well. In an exchange for physicals, it's also like a delivery. However, you don't deliver to the exchange, you find the counterparty and delivery happens off the exchange. Please note, in a futures contract, A and B don't know each other. So whatever delivery has to happen has to be with the clearinghouse. In an exchange for physicals, what happens is that A can go and find B or find another counterparty C and deliver it to C, and then A and C inform the exchange that yes, delivery has happened and you can cancel the contract. So it's pretty rare, you don't really need to bother with this, but just know that this is also one way of terminating a futures position. It's the same as delivery, but delivery doesn't happen with the clearinghouse. It happens with another counterparty who has the opposite position, and both of them then inform the exchange that yes, the delivery has happened, so you can cancel this contract. So for instance, A had to deliver, or let's say A was long and there was another counterparty C that was short. So what exchange had to do is take delivery from the short and give it to the long. Instead, A and C have directly done this, so exchange doesn't need to get involved. So they both inform the exchange that that trade that you were going to do, we have already done. So we have already exchanged the physicals, so you can just finish our contracts. Again, not very important, so don't worry even if you didn't understand. You can do an offsetting trade, a cash settlement, or a delivery that will happen at expiration, or an exchange for physical. This will also happen at expiration. There can be various types of futures. So futures again can be for stocks, can be for currencies, can be for commodities, can be for bonds, can be for interest rates. Interest rates futures are generally referred to as euro-dollar futures. So again, here we will be taking a view on interest rates just like in forward rate agreements. But remember, because it's a futures, these are normally standardized. That's how they differ from forwards. So in interest rate futures, each contract has a face value of $1 million and the quote is 100 minus 90-day LIBOR. So the interest rate that you are punting on is the 90-day LIBOR. If you're positive on the rate, you can short. If you're negative on the rate, you can long, so on and so forth, because the quote is on 100 minus the 90-day LIBOR. So different parties will give a quote, and actually on the settlement date, what is the 90-day LIBOR will decide the payoff. If the 90-day LIBOR is high, then the long will lose because this value will go down. If 90-day LIBOR is low, then the long will gain because this 100 minus 90-day LIBOR will be high. So essentially in Eurodollar futures, the standardization is that each contract is $1 million and the interest rate is the 90-day LIBOR that various parties can punt on. If you think this rate will go up, then you can short this quote because it's 100 minus 90 day. If you think interest rate will go down, then you can long this because if interest rates go down, this value will go up. Treasury bond contracts we'll study in more detail at level 2 and level 3. They are for a face value of 100,000 and gives the short counterparty a choice of bonds to deliver, and they use conversion factors to adjust the contract price for the bond that is delivered. No need to understand the details of this right now at your level. You'll understand in more detail when you do at level 2 and level 3. Just remember that it gives the short a choice of bonds to deliver and uses conversion factors to adjust the contract price. Stock index futures have a multiplier that is multiplied by the index to calculate the contract value and settle in cash. So stock index futures could be on S&P 500, could be on Nifty 50, etc., or any index, and generally will have a multiplier. That is, each contract is for 1,000 shares of the S&P 500 or for 10,000 shares of the Nifty 50. So each contract will be 10,000 times the value of the index at that time. So that multiplier is also set by the exchange. So you can have one contract or two contract. This multiplier will automatically be multiplied to the value of the index to compute the value or the payment at settlement. Again, similarly, currency futures will be for a standardized amounts of foreign currency that two counterparties can exchange or can agree to exchange at a future date. So essentially, there's no real concept in this slide. It just says that futures will be standardized forward contracts. Standardized meaning simple, the quality will be assured by the exchange. Each contract will be for a particular number of stocks or a particular number of bonds or a particular amount of the bond or the currency, and then you can take one contract, two contract, three contracts, so on and so forth. So nothing conceptual, just that different types of assets have different standardizations that is done by the exchange. Not such a big issue in financial instruments because quality and all is not such a problem, but yeah, for commodities and related assets, definitely standardization has to be there because quality can be a big question mark. So that was about the review on forwards and futures. In the coming sessions, we'll study about more derivative instruments, options, swaps, etc. So thanks a lot and see you next time. Practice a lot of questions. It's an easy topic. Don't be scared of this topic. Once you've done enough questions and once you've gone through the concepts a couple of times, you can be fairly confident, and it's very easy to score high marks on this subject. So all the best and see you next time.